You hear? Okay, I'll be straight out. One of the biggest developments in the investing industry in recent years has been the growing popularity of passive investing. Instead of paying to have their money actively managed, investors are increasingly opting to put it into index funds, which are very much cheaper and aim to capture the returns of an entire market by tracking an index.
The term passive investing, I think it's not a very good term for most people to understand, because it sounds like you're standing in the corner, or you're not participating, or you're somehow missing out. And that's that evokes emotions, negative emotions. I like to call, rather than call it passive investing, I call it smart investing, the kind of no regrets investing, where I've minimized the moving parts, I've minimized the decisions I have to make, I've minimized the cost, and I've maximised the chance of me getting the returns from capitalism, which are there for the taking. A passive portfolio can go down just as well as it can go up. And people talk about when stock markets are racing, that's great, but what about when they fall? Well, active funds fall, if not the same, if not more, because of the bets that they're taking. But I think rather than use the word passive, let's use the word smart investing. And what is smart investing? Smart investing is minimising the moving parts and maximising the chance and the amount that you're going to get from participating as an investor in capitalism.
The case for passive investing is based on two related theories: the random walk and the efficient market hypothesis.
Random walk hypothesis is really crucial for investors to understand. It in essence says that the current price includes all the information we currently know and actually the impact of that information on the future. So the change in price in the future has to do with new information that is random and unpredictable. Nobody knows tomorrow's news. So efficient markets has to do again with this idea that all the known information and news is currently embedded in the stock market prices. And the real implication of that is that prices are fair.
If you agree that markets are mostly efficient and that future price movements are unpredictable, index funds are the logical choice. But the biggest advantage of using them is the cost. You can buy an index fund for around 20 basis points. That's another way of saying a fifth of 1%. For an actively managed fund, you're looking at an annual charge of between 75 and 100 basis points. But once you add on transaction costs and other fees and charges, you could be paying at least 200 basis points. In other words, 10 times more expensive than an index fund. Over the course of an investing lifetime, that can make a huge difference.
Every penny that you pay in costs that comes out of your return reduces the impact of compounding. And initially, what might seem a small amount coming out of your money each year actually has a disproportionate impact on the end result that you're going to have. Now, in some cases, if you're paying, say, 1% per annum to someone to manage your money, and you've got a compound return of, say, 5%, it could make the difference between having £4 million at the end of the term and £3 million. I mean, you can choose your term, you can choose your investment amount, you can choose your investment return. But the point is that small deductions from your money on an ongoing basis actually have a massive impact on the end terminal value that you'll end up with.
In the US in particular, there have been huge outflows of money from actively managed funds and into low-cost index funds. In the UK too, more and more investors are now choosing to take the passive route as concern grows about the performance of active managers and the industry's unwillingness to introduce lower, more transparent fees for active funds. Some in the industry have warned that indexing is becoming too popular. But that's not a concern shared by Ben Johnson, Director of Passive Funds Research at Morningstar.
You look at the growth of passive investing, it's clear why these concerns have been raised, because passive investing, index funds, exchange traded funds have been growing at a pace that has far outstripped the growth, which has actually in some cases been attrition of traditional actively managed funds. Now that said, these are by definition very low activity managed funds. So the real concern should be, who is doing price setting at the margin? Does it continue to be well-informed, well-equipped active managers, or is it just passive funds that are blindly buying securities that are setting out to track the index? These low activity, low turnover funds are actually doing a very tiny fraction of the actual trading in securities markets, which is where actual price discovery is taking place, where prices are being set.
Finally, what does Warren Buffett, probably the most famous investor of all, make of index funds? The answer is he loves them. In his February 2017 letter to Berkshire Hathaway shareholders, Buffett was hugely critical of active managers, hedge fund managers in particular, and of the fees they charge. Both large and small investors, he said, should stick with low-cost index funds. There is a third way between active and passive factor investing.
Femme en French, uncovered that there had been higher returns among small companies and among value companies.
Some say factor-based investing is becoming too popular as more and more people tilt to different factors. Might the premiums those factors are expected to deliver disappear?